episode of Market Masters, I sit down with Blayn, the trader behind Darwin IME, to talk about his experience moving from discretionary trading to building out full portfolios of expert advisors, doing all the heavy lifting for him. We talk about his experience with Darwinex, managing 6 figures in investor capital, which is currently sat over $300,000, and what it's like to be part of DarwinIA Gold. Make sure you stick around and listen to everything that Blayn has to say. This was an interview that changed a lot for me, and I really hope you guys enjoy it. Let us know in the comments what you liked about this interview and what you'd like to see moving forward. Other than that, welcome to the interview, dude. It's a pleasure to have you on.
Thank you. It's good to be here.
Yeah, I mean, we've been trying to set this up for a while, haven't we? And finally, our schedules have aligned. So let's jump straight in, Blayn. Let's talk about how you got into trading and what your first experience was in the market.
Yeah, so I actually first got into the markets primarily through stocks. When I was 18, my father gave me a tiny bit of money to put into an ISA and basically said, if you learn how to play the stock market, you'll do well in life. Yeah, to be honest, the first year I didn't really take too much interest. And it was only until I was like 19 that then I was like, right, okay, I've got money just sitting there in an ISA doing nothing. Let's see what I can do. So I just kind of done research based on, the things that I know. So back when I was younger, I liked to do quite a lot of gaming. So I was looking at, okay, investing in things that I found a stock called Gfinity, which was like one of the first ones to get around. I think it was like esports within the UK. Put my money in that, hoping it would go up. It went up like 100% in the space of like a month. And to be honest, I didn't know what to do at that point. I had no exit strategy. I picked a winner, it was up 100%. And I was just like, what do I do? I just kept on holding it. In the end, it like dropped almost back to my entry point, got out, and I was like, right, okay, I've got to do something different this time. So from there, was very active in research for looking at stocks because I didn't know about FX trading or anything like that at this point. So I was just picking stocks when they were up like 10-15%, selling them, and that worked okay for a couple of years. But the kind of FTSE was kind of like stagnant, nothing much was moving. I was only investing in UK companies, so I kind of just stopped there and just like kind of left it because I was at uni at the time. So yeah, I just stopped that, concentrated on my university degree. And while I was at uni on my dissertation, I was doing wave forces exerted on cylinder structures because I was doing an engineering degree. And I typed into, I was doing research, I had to do like a whole study on it, experimentation. And I typed in wave forces on CFDs. CFDs is like a simulation that you would run for doing waves. And from that, I came across Elliott wave theory on contract for difference, which was bizarre. And yeah, I was like, okay, interesting. Because obviously I've been doing like stocks and that before, I was kind of intrigued by it. So I kind of read into it and kind of got deviated from a university degree as such and just kind of looked into this. I was fascinated by it, that, people were essentially like plotting on a chart waves and trading them. So from there, I just put a couple £100 in like a trading account and started trading probably, I can't remember, 2019, 2020, something like that. Maybe just before that. I can't really remember the exact dates. And was just looking at the chart, trading the waves with the trend. Done good, probably almost like doubled like a £200 account into 400. And then there was one day that I was at work, opened my account, down 50%, lost all my gains because I wasn't trading with a stop loss or take profit. I honestly thought like just trading the trend, it was going so well, nothing really could go wrong. And yeah, it went wrong. So from that point, I knew, right, I really enjoy doing this. We've got to look into how can we make this into like a viable strategy? Is there any way that I can learn how to turn this? Essentially, it was a hobby to begin with, more, intrigued into something I could do because I just really enjoyed doing it, and went down that typical route of the retail traders where we joined communities, try find strategies, tested loads of different things, and went through a few. Had success with some, and then there was always some sort of flaws to a lot of these strategies, as they weren't probably tested back long enough. Maybe they were only tested on the latest year, or you found some of the educators were actually fabricating the results, if that makes sense. I think everybody's experienced that at some point. And then, yeah, found a strategy that really resonated with me. It was more supply and demand. You could say trade in the waves, but except the reversal rather than with the trend. Made it kind of like as mechanical as possible as I could do. There was obviously elements of discretion with the manual trading, and I'd done that for like maybe like a year and a half, 2 years, something like that. And the downside to manual trading and the edge to my strategy was I needed to check the charts every 4 hours, sometimes every hour, just to make sure that I was capturing every trade possible. That meant, if I'm asleep at night, set an alarm to get up at 2 in the morning just to see, just to make sure that I'm not missing any opportunities. And for a while, that was all good. I didn't have a problem. Was making a good return. It was very consistent, but it was towards like the end of like the year, I felt really tired. I didn't really do too much apart from trade and go to work. And I just asked myself the question, like, is that sustainable? And that's when I made the switch to algorithmic trading.
Yeah, and we'll talk about that switch in a moment, but I just want to go back to a couple of things that you mentioned in that. The first thing being, do you think when you started trading CFDs and when you doubled your account and then you was down 50% in a day, do you think you was approaching your trade in the same way that you was approaching like the stocks? Because when you buy a stock, your only exposure is the money you put in generally, right? So you're
Yeah,
never going to be leveraged up and end up owing the broker money, if you
yeah.
get a margin call, for example. Whereas when you made the switch to CFDs, was you aware that you could lose more than you put in, or you could, the basic how margin works, how leverage works, the fact that you are probably really overexposed? Like, did any of that go through your head at the time, or was you approaching it literally the way you bought stocks and held them?
I had no idea what leverage was. I had no idea that if you made some bad trades, you could owe the broker money. That learning came at a later date, and luckily it was only a 50% loss. And to be honest, didn't really lose anything in the end. But yeah, I mean, I was just approaching it like I never really like sold anything. Like I thought the sell button was more, you're selling after
The
you've bought
enemy.
rather than you could short sell something. So I
Yeah.
was only ever buying. But no, I was definitely not aware when I first started about these important things when you're trading.
Which is ironic, right? Because the industry is so accessible from a standpoint of you can open an account and have your credentials probably within 2 minutes, right?
Yeah,
You can then deposit money. And I would say within the space of 30 minutes, you could have created an account, you could have downloaded MetaTrader or whatever app you're using, deposited money, it's cleared, and you can be opening a trade. But there's no one there to say, hold on a minute, do you actually understand that if you click that button, you're without a stop loss, especially that you might have a phone call in 20 minutes from your broker saying, we're margin calling you need to deposit more capital or we're going to close your positions. Like, it's quite a scary thought, right? Like, I genuinely wonder how many people have been through that but haven't survived the way that you have. I have a very similar story that I won't bore you with, but it's pretty much identical to yours. Doubled my account the next day, down 50%. I had a panic, I closed the trade, and then that for me triggered, there's proof of concept
yeah,
because I made money yesterday, but now I've got to figure out how do you not lose 50% of it the next day. But
yeah,
the other thing that I wanted to ask you, you said that your dad kind of imparted a bit of wisdom to you that if you know how to play the stock market, like you'll kind of be a cash machine forever, like that
yeah.
kind of thought. So was your dad actively involved in the markets, or was he kind of from a long-term investing, just here, there, and now and again?
Not really. He had his stocks and shares ISA, but he wasn't like an active investor. It was only when he was working within his company that his boss basically had a financial advisor that basically gave guidance on pensions. and
Okay.
basically explain to like the guys in the company, if you do these things correctly, you can make a very comfy retirement essentially.
Mhm.
And what he says to me is he wish he knew all this information when he was younger. So um, I was young. I didn't really take it in to begin with, but yeah, feel very fortunate that I was given that information quite early.
Yeah, I think that's really important as well. I've spoken to a few guys who are like 16, 17, 18, and they've either found their way into a Discord server that I'm in, or I'm chatting to them through a community, whatever it may be. And they're talking about, the fact that they're into trading, they're thinking about money. And I'm thinking, when I was 16, the last thing on my mind was trading, investing, making a
Yeah,
return, all that sort of stuff. I was busy with friends, doing all the stuff you do when you're a kid. But I
yeah,
think if you manage to get that advice and you absorb it at such an early age, in this game specifically, before you have the ability to generate any poor financial relationships, i.e., a poor relationship with money where you have like a scarce mentality, you're scared to lose money, all that sort of stuff, which I think can come in many different shapes or forms, but they're so young and malleable that they get such a head start in this career. By the time they're 25, you could have made just an insane amount of money. And I mean, I wouldn't say I started late. I feel like I did when I speak to guys like this, but it's never too late to get on board, I would say, especially what we've seen over the past few years with things like cryptocurrency, metaverse, AI stocks, all of these different niches that have blown up. Even now, where the S&P, the Nas are just hitting all-time highs, gold's hitting all-time highs. It kind of highlights that it doesn't matter when you start, because the market is always going to have these periods of, we can call it irrationality, we can call it normality, however you view it. To me, it's a little bit irrational, but
yeah,
the market will always be making these moves to capture.
yeah.
So
There's always going to be opportunity.
ex- exactly.
That's doesn't matter what market it is. There'll be something that there'll be a heap of opportunity for someone to take advantage of.
Yeah, and so let's talk about that actually, because you and I had an interesting conversation before we jumped on this. I know you're going to share your screen and show some statistics, but
Yeah,
on that point where there's always going to be opportunity, it's kind of down to you how you decide how you're going to capitalize on that opportunity, right? Now,
yeah,
we had a conversation for the viewers watching this. Blaine and I had a conversation. Um, and he made it sound to me as if his discretionary trading approach was really poor, and therefore he decided to look at automated trading and coding his own systems, which he's done very successfully now. But when he showed me his manual track record, I was pleasantly surprised. And we're going to bring that up in a moment. But I want you to talk about, Blaine, about that transition period. What made you decide from going from a discretionary approach where you're making all of the decisions, the responsibilities on your shoulders, from a human being perspective, day in, day out, to actually automating everything, to coding your own strategies and letting it run? I don't know how much interference or management you have, whether you just let the EA or the robot execute everything, or whether you manage it as well, which I'm sure you can explain. But what was that transition period like, and what made you actually bite the bullet at going fully automated?
yeah. So obviously, I explained previously about having to trade all hours of the day, every
Hmm.
day. And when we get onto the statistics at the very end of that sort of statistics, I literally started loading up the account, put loads of money in, and then went through like what I would see as a quite a big drawdown from a money perspective to begin with.
Hmm.
And after that point, it was more the emotion started kicking in for the very first time, really, because throughout that period, it was all looking good. Um,
Let me
and
let me bring up, while you're
yeah,
explaining that. Let me actually bring up your track record so that we can see what you mean by the drawdown and the loss in financial sense.
yeah. So like from the statistics, you can see the overall gain is like 68, but the absolute will be lower. But that was just due to, as getting more confident with the strategy, I just started putting more money in and more money in and more money in. But I just kept the approach the exact same, never
Hmm.
really changed anything. And then it was you'll see like the difference between the equity line and the balance line. At one point, the equity line I think was up almost about 88%, and then by the end of September, it was only up, say, 68. So it is quite a big difference between, you know, when you're up 88% and then you're only at 68. Yes, you're up, but at that point in time, the account was over six figures. So I think relatively, like, the difference was almost 10 to 20 grand.
Mm-hmm.
And yeah, that's when, first of all, it kind of affected my psychology a bit with how I was trading. You know, I knew the statistics of the strategy. I knew there could be drawdowns like that, but emotionally, I was just like, okay, this is quite tough. Like, you know, most traders will go through it. So I thought, okay, how can I take the emotion away from this? And I done like a course on algorithmic trading. Built some basic breakout systems, tested them, put them on small amounts of money, then started adding money. And from that point, I've never really kind of looked back. The psychology has never really, because I'm not making decisions anymore. I don't interfere with the EAs or the algorithms at all itself. So, you know, if it's within the limits, is what I would say. You know, most of it is data driven. So you're all going on statistics rather than intuition when you're trading manually. So as long as it's within the parameters of the statistics, I'll just let it go, let it keep doing what it's doing. I don't think I have actually intervened at all since running these systems live.
Okay, and I think it's important to mention that the track record that we've got on the screen now is your old discretionary approach, right?
Yeah,
So
yeah.
The gain, I can't see it 100%, but it looks, is it 68% or 48%?
68.95.
Okay, so 68.95% with a drawdown of 13%. So for the majority of people, that is still, you know, pretty desirable from a return to drawdown perspective. But I completely understand that, you know, when you're at that peak, and like you said, you knew these drawdowns came with the system, but when you're in it and you're in the thick of it and you see your equity go from, let's say it's 100 grand back down to 90 or whatever the figure may be, it really can have that emotional toll on a person, right? Especially if it's the worst. Like if you've had a year of great performance with relatively low drawdown,
Yeah.
it doesn't matter how professional or how consistent or how long you've been doing it, though that period still has an effect on you, right? Would you agree?
Yeah, absolutely.
And then, so nowadays you're only trading automated, and obviously you joined Darwinex and you started trading with us. Blayn's Darwin ticker is called IME. So could you pull your Darwin track record up as well, please, Blayn? We can do it on my FX book first, and then we'll compare it to to the actual Darwin return. Because Blayn operates with a value at risk of under 3%, so his Darwin is actually tuned up pretty much like by 2x. I would assume, maybe slightly higher than 2x. So yeah, just talk us through, because this is since February 2024, right?
Yes.
So talk us through this system. Like, is this, I know you mentioned that you built some basic systems first. What got you to this point where you go, this is the system, this is the one that I'm going to put forward, this is the one I'm going to look to build a track record with, grow investor capital, and how do you manage it? Because this is really interesting for me, right, is the fact that you've generated 20+% return and you've got a drawdown of 3% whilst trading algorithmically, which is very difficult to do. So, you know, I want to commend you on that. But just talk to us a little bit about the strategy and how it came about.
Yeah, so from that period at the end of 2022, I developed so many systems as such. And what I would do is I would trade them individually in their own accounts. So, you know, there would be loads of, it was kind of a problem of trying to track them all in different accounts, making sure that, you know, I'm opening up different accounts on MetaTrader. When you're running a VPS, having so many things open, it was just kind of a bit all over the place, a bit cluttered. So I just decided that I would put them all together, all my best systems together. But what I want is the lowest drawdown possible with returns that, well, what I want to do is beat the S&P with the lowest possible return. So what I did is I think in this portfolio, there's honestly about 19 to 20 systems.
Oh, really? Oh, wow.
And
Okay.
what I would do is I would reduce the risk so low that I think most of them will operate between 0.05% risk and 0.1% risk. So seriously low risk
Mhm.
parameters on each of these algorithms. But what from what I want to do is, if you uh, look at, let's say you're looking at like an oscillator, you'll notice that it goes up and down quite heavily the lower that you put the RSI. So if you put an RSI 2, it's going to go between 10 and 90 a lot. And if you risk more, that you're going to see bigger swings. So what I wanted to do was, you don't notice something when when a vibration is so small, you don't even think it's moving, but it is vibrating very smallly. So what I wanted to do was bring in essentially what I call as a vibration, and bring it so small that you don't even notice the losses that much, but it's still chugging along, making a return with that positive expectancy of each algorithm.
Okay, so that's interesting because I didn't know before we jumped on here. I didn't know that this was actually being ran as a portfolio, which I think everybody should try and get to that point anyway, where they have kind of their master record, which is a portfolio of all of their trading strategies, whether it's discretionary or manual, because you're ideally, the way I think about it, when you're building a portfolio, you're diversifying the risk, but you're not necessarily sacrificing too much of the reward. So if you've got, let's say you've got three systems that all generate a positive expectancy or a positive return over time with various different drawdowns, you can tune each individual system, like you say, to reduce the risk, to keep the return positive, but you're minimizing, let's say system A hits its largest drawdown in September, but system B doesn't hit it till the following January. Like, the max drawdowns aren't all added together, if that makes sense.
Yeah.
So the drawdown risk is kind of spread. That's why I love portfolio systems, because they generally last a lot longer, because you can always tune each individual
Yeah.
system. So do you do that a lot? Do you go back to kind of your weighting in the portfolio and fine tune each system, or do you just have you set it up in February and just let it run since?
Yeah. So, like, I've added strategies as time's gone on. I've removed strategies as time gone on as well. Very little interference, really. I think I've only removed two and only added like two, so not really much at all.
Mm-hmm.
So I just kind of let them run at the risk parameters. Let's say one system takes like 2,000 trades, right? And one system takes 500. I'll risk less on the system that takes 2,000 trades, just so then the average risk per, like, how do you describe it, per trade or over 1,000 trades is almost the same. So therefore, it lets all systems run equal risk over time per, like, say,
Yeah.
1,000 trades, if that makes sense.
Yeah. Yeah.
The best thing about running it like this way with such a low drawdown is, let's say system A has a max drawdown of 3%, right? Let's say it goes into that 3%. As long as as long as it's uncorrelated to the rest of the strategies, it's not going to really make too much of a dent in your balance or your equity. So you can pull it out without it even hurting you. Where, like,
Yeah.
if you risk, say, 0.3% or even 1% per trade, that would be equivalent of like a 20% drawdown. You're going to notice a 20% drawdown in a portfolio, even if you're running multiple EAs as well. So the way that I look at it is, let's say things are worst case scenario for certain systems, I'm still running, with a good balance. It's not going to affect the psychology. I can add something or, tune it to make sure that it performs again. And it allows the balance to keep growing at that kind of steady rate. That's the way that I've basically designed this kind of portfolio.
And did you have any sort of coding experience before, or were you? Because you mentioned you did a course in algorithmic trading. Was that your first exposure to coding, or had you done some prior to going to university and doing engineering?
No, no, that was my first exposure.
Wow. Okay. That's pretty impressive, dude. I'll give you that. So how long ago was that you actually went and started the algorithmic stuff?
So that would be about probably 2 years, 2 months, something like that. Maybe three
Wow.
years, between 2 and 3 years.
Okay. Yeah, that's That's seriously impressive. And you would never go back to discretionary trade. I know you said earlier that you would potentially discretionary trade on the side, maybe for a bit of fun, but you'd never give up automated for that discretionary approach.
No, because at the end of the day, when you're running automated systems, you're making sure you're taking advantage of every single opportunity and every edge that presents itself.
Hmm.
Whereas, let's say you're a manual trader, something comes up, you potentially, and you've missed the trade. Depending on the strategy, you could have missed the best trade of your year that
Hmm.
makes up, say, 60% of your gains for the year. Whereas when you're running automated systems, there's no need to worry. It's capturing that edge in every instance.
And so the all of the strategies that are run in the portfolio,
Yeah,
you ensure that obviously that none of them are positively or I guess there's going to be some correlation between strategies if you're running that many, but how do you ensure that you minimize that? Do you trade different assets on each strategy? Do you trade different like like trade durations? Like what do you do to ensure that your strategies never push that correlation?
yeah. So some of the strategies will be correlated because they'll trade the exact same pair, but it will be either on a different time frame.
Yeah.
The stop losses. So some will have large stop losses to capture big moves. Some will have smaller stop losses to catch, say, intraday moves. Some are time based, and the entries are totally different in all of them. I'll trade currencies, commodities, gold. They're the main things that I look to trade. I predominantly trade mostly breakouts, so I look at the markets that are trending the most, the best. And there is a way of determining when a trend. Every market trends at some point. You've just got to kind of discover when to turn on a system to trade when the trend is hitting. So like if you look at euro dollar, for example, 2018, 2019, very low volatility, not moving at all. Now, if you look at recently, euro dollar has been moving a lot. So, it's been my system, one of my systems has been trading a lot more on euro dollar because the volatility's picked up.
Yeah.
So it's mostly about, different markets, but tailoring it to those markets based on volatility if you're doing breakouts.
Yeah. I mean, I love automated trading, but I've kind of only dabbled in it and dipped my toes. I've never really jumped fully
Yeah.
in, but I think it's super interesting. That's why I ask questions in these interviews that actually interest me, because it's something that I mean, I'd love to explore it more myself. I've only ever really traded discretionary,
Yeah.
but I have very limited coding experience, so I can build a system, but it's nowhere near what it needs to be. But when you first started and you first did that algorithmic trading course and you first started dipping your toes into coding and setting up these systems, did you feel kind of a sense of freedom, or was it more like frustrating, the fact that you used to be able to make a decision in your brain and press a button, and now you've got to get that brain logic into code and then test? Like, it's a completely different setup, right? So did you feel restricted or free straight away?
There was such a big learning curve as to, it's like teaching, I don't know how to describe it, maybe a baby how to walk. It's never gonna happen, but it'll click one day.
Yeah.
Um, yeah, there was so many head bashing. It was such a big learning curve just to get my thoughts and ideas into a system that would actually trade what I want it to do or how I want it to do. Once you get past that stage and you kind of just build a foundation on like how to build a system, you can then start really expanding and growing and getting loads of different systems that you can trade. But to begin with, it was quite frustrating because I wanted it to do one thing and it would not do it. So there was a big learning curve there. But yeah, once you get it down to a T, most things will be very similar in what you're doing,
Hmm.
and you just build on it from there. It's the first like 6 months to a year, definitely your building phase. Nothing's going to be perfect, and then once you're kind of in a rhythm, doing it every day, learning new things on how to structure certain EAs, then you get in this rhythm and you can start building quite a lot of systems, even in a single day, then really running the data-driven models.
But just off the back of that, what code? I mean, this is only going out to or this question is only going to resonate with coders, right, or automated traders. But what programming language do you use to code your systems?
It's all in MQL5.
All in MQL. Okay.
Yeah.
Because like I said, just I've dabbled with PineScript, which is TradingView's native thing, but it's quite. I feel like it's quite restrictive. Obviously, it's got to run through TradingView. It's very difficult to actually get a professional system, I think, from PineScript. I don't know if you agree.
Never really done PineScript.
It's from my experience, and like I say, I have very limited experience when it comes to programming, but it's very easy to code. Like, it's a very simple language. But it's with that simplicity comes restrictions, right? So you don't have as much freedom to code certain bits of logic and stuff. But then, I'm just interested because I know a lot of people use MQL, but then some people use Python. So I was just interested on your take. But could you do me a favor and bring up IME for me so that we can take a look at your Darwin?
Yes.
Because again, as I mentioned, Blayn, I think we checked just before we jumped on the interview, Blayn's value at risk right now is 2.96%. So obviously we risk adjust all Darwins to a value at risk of 6.5%. Now Blayn is obviously under half of that. So his Darwin will be trading pretty much double the size of what his track record is on the screen now. It'll be double and then slightly higher. Just because you're under 3%, right, which is half of 6.5%. And the reason we do that is we like to mirror the volatility of our traders to the volatility of the S&P 500. But we have much more content and stuff that you can watch or read, which explains why we do that sort of thing. But I know Blayn wanted to talk about the risk engine. So when we get the Darwin up on the screen, we can take a look and do a dive on that.
Yeah. 2 6.
So this is IME, which is Blayn's Darwin, which again is the Darwin or the risk-adjusted version of the strategy we've just been looking at on my FX book. And so you can see through Darwinex, Blayn currently has 26 investors, or I'm not going to say Blayn, I'm going to refer to you as IME for this. So IME has 26 investors, which totals $310,000 on top of 195,000 euros, which is great going considering your record is just over a year. I also think that hopefully we can kind of shine a light on your record, because I think this is very, very attractive to investors. So right now he's returned 40% or just under 40% since February 2024. And of course, like I said, IME is being scaled up by the risk engine. So the drawdown is slightly higher than the original track record that we looked at. So this is 6.35%, again, double and then, slightly higher. There's an interesting one that I'd like to look at, Blayn, which is if you click on the capacity attribute at the top right. So you see your 10 circles. If you just click on that for me.
Yeah.
And then you see at just under the CP that it says all. So you've got a few different time frames.
Yeah.
Okay. The only reason I wanted to look at this was because you're running it as a portfolio and everything. So all the individual strategies are running at such a low risk level. So if you could just highlight or hover right on the end of the chart for me. Okay, yeah. So basically, if you are unaware, on Darwinex.com, when you have a Darwin, you can view your capacity, which is your alpha cap or your max investment that your Darwin can handle. And we judge this, or we assess this by measuring the toxicity flow of your orders. We then calculate what your investors would have if they had a divergence in pips. So for example, if an investor was getting slipped 0.5, 0.2, 1 or 2 pips in slippage per trade based on the toxicity flow of your orders, and we measure what their return would be, and therefore we give you a max investment, because we can't advertise a strategy with 40% return if we know your investors are going to get slipped because of the size they're trying to execute, and then they're getting, a 10% return a year. So I just wanted to check this because of the way you approach things. But your Darwin's up 41.24% at the last time this was calculated, which was on Tuesday. And if your investors were getting slipped 2 pips per trade, on average, they would only be up 8.55%, which is a
Yeah.
pretty big difference, which is the reason why we do this. So if you can scroll down for me, I just want to see what your max investment is. And there is a reason as to why I wanted to look at this. So
Yeah.
just stop here for me, and then you can see there's a chart: capacity, max estimated investment. Okay, so your maximum investment for this for IME is 22.5 million, which is great, right? That's kind of, I mean, if you're managing 22 million, that's a pretty significant chunk. And the reason that I wanted to check this was because it's not a single strategy and because it is a portfolio of systems all running together. Generally, your alpha cap is going to be slightly higher because you're trading lower size. You're letting different trades breathe because you've got, like you said, some trades might be holding for longer, some might be shorter, they're uncorrelated. But yeah, I just wanted to highlight because I've been doing a lot of these analysis recently on Darwin's, and we've been finding that a lot of people have quite a low maximum investment of like 1,500,000. And it always surprises people that that's the maximum that they can manage. But then, you know, they might be executing a trade with a 3 pip stop and holding it for 5 minutes on, you know, some illiquid Euro Aussie pair or something like that. But I just wanted to highlight the importance of running as a portfolio for traders who aren't doing that. It allows you to grow more, it gives you more flexibility, more fluidity with the different systems and optimizing them, and usually allows you to manage more capital as well. So thank you for that, Blayn. I appreciate that. I'm probably going to snip that out and use that for a bit of social media content as well, because this is always one that I try and get good examples for because it's very, very difficult to do so.
No worries.
And so you're also in DarwinIA Gold, which
Yeah.
for anybody who is unaware, you have to hit certain performance milestones to get promoted from DarwinIA Silver into DarwinIA Gold. So you pretty much hit all the milestones that I would look for to get somebody on an interview. So congratulations to you, dude. You've done an absolute fantastic job.
Thanks.
But if you could go on to the risk stability attribute for me, and then you can touch on the risk engine and how it complements your strategy, the way you was going to talk about.
Yeah, so the risk.
Before I ramble on anymore.
No worries, man. Yeah, so one thing that like I found quite impressive when starting off with Darwinex was looking at all these different metrics. And because I built a portfolio on such low risk, I was interested to see how the way Darwinex scores work in terms of how they score it. And I was quite impressed with how I'm risking a lot less with such a low sort of risk model. And their system is like, okay, we can up the risk because it's such a low risk system. And I like that concept because it's what I've seen so far is it's upping the risk when it's good to up the risk. But I've seen also like the VAR drop as well. So like get closer to the 6.5 when times aren't as good. So I found that very impressive when trading on Darwin so far.
Yeah, so it's kind of like having, I mean, I always explain it this way anyway. It's kind of like working at a professional prop desk or hedge fund or investment bank, wherever you would be, and you would have an independent risk manager watching over your shoulder anyway and kind of looking at your trades and your strategy from an unbiased perspective, right? And being able to intervene if and when needs be, kind of thing. So I love that because I think a lot more people should embrace the risk engine instead of looking at it as a kind of limiting factor, because it can help you grow as a trader. It can help you learn more about your system, and ultimately it allows you to attract investor capital in a regulated way, right?
Yeah.
You're currently managing $310,000 from external investors. It would be difficult to do that elsewhere, because you do have to have, unless you can operate within the framework of a third party company, you obviously have to hold certain certificates of regulatory cover and requirements. So it's absolutely fantastic. And I for one would love to see IME just keep going and growing from a AUM standpoint. So again, I'm hoping that this interview kind of shines a light on IME for you. But talk to me about strategy development. So with all these statistics, and I'm pretty sure you probably spend the majority of your days analyzing and taking a look at your strategies. What's your approach to improving them at a granular level? So not a portfolio level. When you're looking at the performance of each individual strategy, what is it that you kind of look at, and what is it that you would try and improve over time?
Yeah, so whenever like I'll look every month, I'll look at how each individual strategy has performed. You just do this simply by using like magic numbers on my FX book.
Hmm.
And what I would do is I would then run a back test of that exact same strategy against the historic data that I've got and make sure that they align. If they don't align, then I know, okay, something's wrong or something is not right with the system as such. Because let's say on the historic back test, it's made like 5%, but trade in real time is like -2. Something isn't adding up. And then I'll just go through and look at the charts, look at the orders. Let's see kind of what's went wrong or what's doing well, if that makes sense. In terms of like improving a system when they're live, I don't really touch them much because so far, touch wood, I've not had to do much with them because of the way that I develop the systems. So
Hmm.
the way that like I'll develop the systems is, let's say I'm taking a 50 bar daily breakout, for example, right? Whenever I run a test and optimization, I'll then look at multiple different stop losses, for example. Let's say I'm running 0.1% stop loss all the way up to say 5% stop loss. What I would want to do and what I'd want to see is where does it work and where does it not work. So because I've got like engineering background from university, we'd use like what's classed as a factor of safety. So I've kind of created a robustness sort of metric that if it falls within a factor of safety, if I go smack bang in the middle, it might not be the best result, but it means that I've got leg room each way. And what I'll do is I'll measure these every month anyway when I do the back test as well, just to make sure. Let's say I've got a 0.5% stop loss, right? As time gets on, 0.6, 0.7, 0.8 metrics are getting worse, but say 0.1 is getting better. Then I would then change the stop loss to fall in line with that sort of robustness factor of safety. So it is a dynamic sort of like stop loss. I've not had to change anything since, but that is my plan of action, if that makes sense. So that's how I would go and improve in the strategy is as long as like let's say it's getting a 1-to-1 of over 50%, that's how I would decline. That's how I would declare something as being robust and an edge. If I'm not hitting a 50% win rate on a 1-to-1 basis on say a breakout system, then I know that majority of the time it's more how I described as luck rather than a statistical edge.
Hmm. Hmm. Okay, that's interesting. And so, moving on to your kind of job as a trader outside of the monthly analysis of your strategies and the small refinements that you would do from like a stop loss perspective,
Yeah.
what is your day to day like now? Because again, like me and a lot of other traders who approach with a discretionary edge, I guess my day would be very, very different to yours. Like you don't have to come in. I mean, maybe you do. You might scan the markets, but what does Blayn do from the moment he wakes up till the moment he goes back to bed at night? Like when it comes to trading, you don't you don't have to declare all your life secrets. But
Yeah, yeah. No, I'd get up pretty early, around 6 anyway. Have a look at what the market is doing. Let's have a look at, has there been any trades executed? Make sure they're always correct.
Mhm.
One thing that you'll always have to look at is the VPS. Nothing's gone wrong with that because I've not had any problems. But when you do the research, is sometimes like let's say it's gone for an update, it
Yeah,
might not be live.
been
My
there.
one was at the weekend, so there's no worries with that. But there's always that kind of thought in the back of your mind that you're checking every day. Just getting the routine of checking every morning.
Yeah.
From that point, it can vary in a week because I'll set certain days just for pure research. So, as an algorithmic trader, you want to be testing as much as possible in as little time as possible. But you want to be efficient with it. So I'll spend like a whole day potentially, maybe not a whole day, but I'll spend a whole day researching. So that could be reading books, It could be just going through YouTube, taking strategies. Majority of them won't work, but it's always, as long as there's loads of ideas flowing and you're always creating something new, testing these on different markets and letting the tests can take like hours to run depending on how you build them. So it's quite easy to find something else to do. So like, when I have an idea in that day when I'm doing like brainstorming, I'll have a test run in the background. So it means that I've always got a fresh idea to then
Yeah.
test something else again and test something else again. So it's always like you're creating like a constant feedback loop. If it's good, then I then put it to the side and spend a whole day on strategy development of that particular strategy. If it's not good, in the bin, next one. I think one problem that when I speak to people is they'll be so hooked on one strategy and trying to make it work and basically over optimize it to the market condition that it's in.
Yeah.
If you're wanting to build systems fast, and like simple is always the best. Like there's a lot of simplicity to most of my strategies in terms of like entry. Most of the good stuff comes from maybe adding maybe one filter or optimizing stop losses, take profits, everything like that. But what you want to do is just build something, have a tick sheet, yes or no, move on to the next one. Then spend a whole day, say tomorrow, optimizing it. And if you don't get anything that's worthwhile trading, again, put it in the bin, move on to the next one.
Yeah. And I think what you've kind of brushed over there, but is a really, really great skill, is kind of time optimization. Like you're talking about the feedback loop, but it's a really, really clever way of maximizing your time every day. And it's something that I'm huge on. Like I have
Yeah.
a little bit of OCD when it comes to that. Like if I know that I can if I've got 2 or 3 tasks, but I know I can set one that will run whilst I'm doing the other 2, I'm
Yeah.
always forward thinking like that. And it's very much similar to what you're talking about. If you've got a back test
Yeah.
that you can run and you know that that's going to take 4 hours, well, great. You've just marked out 4 hours of your day to complete every other thing that you're going to do. Whereas a lot of people will put off the 4-hour task because it's such a big task, even though they haven't necessarily got to do anything because it's a back test. But I think that's a great skill. And when you're as busy as you are managing all these different systems, testing new things, creating that feedback loop, time optimization. I mean, even for a trader like me, like a discretionary trader, I think as a trader, you have to have some element of time organization. Otherwise, you just end up spending way too long on things that don't matter. Again, like you say, trying to optimize a system that is just inherently garbage rather than
Yeah.
dropping it, understanding it's actually better to drop it. If you've spent 2 weeks working on a system and you're feeling like you're attached and you can't let go, it might still be better to drop it, build a new system, spend another couple of weeks coding it, testing it, developing it, than it is to try and turn your garbage system into a good system, right?
Yeah, because if you're turning a garbage, you've got a system that just doesn't work, you can over optimize these systems. You can make perfect. The big problem I have, if sometimes if you go in the MQL5 marketplaces, they'll show the perfect backtest. Anybody, once you know how to do algorithmic trading, anyone can create the perfect backtest. So like you can make any bad system good just by over optimizing.
Yeah, of
You don't
course.
want to get down that rabbit hole. You want to make sure the systems are simple, robust, tradable,
And
and
like
have
you
logic.
said earlier, having what was it? Was it the factor of safety you was calling it? Oh, your audio's cut. Perfect. So yeah, going back to the question that I had before we just had those audio issues.
Yeah,
You mentioned the factor of safety, was it that you
yeah,
called it?
yeah.
So when you're talking about overfitting these strategies and over optimizing them, I guess instead of trying to get it as the best performance that you possibly can for a specific period of time, going back to the factor of safety, it's better to have, let's say you got 3 different back tests, right? You've got
Yeah.
2021, you've got 2023 and 2025 as 3 separate periods. instead of having 2021 as a really poor performance, 2023 as, you know, okay performance, and 2025 as great performance, and like you go, oh, the system's great, it's smashed it this year, done really well. You'd rather have kind of a medium to high performance that's more steady across all three, you know, back testing periods. Is that kind of what you meant by factor of safety?
Yeah, I mean, performance can vary depending on the sort of system year on year, but
Hmm.
you know, it's more to do with, I'll give you an example. Let's say, you know, what's a typical strategy you see online? Let's say we're looking at a London breakout system, right?
Hmm.
And you want, if you close the position at 12, calculate what the average move is. You know, don't go for like a 1 to 5 if the average move is not going to reach that 5.
Yeah.
So you want to create a target that's around that average, if that makes sense. Stop
Yeah.
loss, you want something that, okay, let's look at if it goes to the negative side, what does the average negative side look like? You know, then you can build a stop around that as well. So what you're doing is building it on data-driven statistics.
I was going to say, and that's where you pull the data from. Like, that's kind of what you're looking for. You're looking at averages of everything to kind of build a system around those, right?
Yeah, to an extent, yeah.
Because I guess you kind of have your execution criteria, you have your invalidation levels, and then it's about figuring out how to optimize it. Is kind of looking at, well, how far on average do these trades move? Especially with a breakout system, you need to know that, because
Yeah,
breakouts aren't always confirmed straight away. So how far on average do they move? How far on average do they squeeze? Because at least then you can build a system using those averages with the execution criteria that you've already
yeah.
predefined, right? Okay, so that's been really insightful, especially for me. Like, I love these conversations because I speak to so many different traders, and I mean, selfishly, I pick up a lot of tips and tricks, and you've kind of made me want to dip my toe back into algorithmic trading again. So I definitely gonna pinch you for a private conversation. But
Yeah.
just to kind of wind this interview down, what does the future hold for IME, and what does the future hold for you? Like, where do you want to go as a trader? What do you see the end goal being as?
Yeah, so with IME, obviously, I want that to grow as far as it can grow with as little intervening as possible.
Hmm.
Obviously, depending on how things go over the years, I'll, you know, do the usual build, add, subtract systems,
Yeah.
but predominantly that's basically just breakouts and momentum sort of strategies. I want to sort of build a portfolio that kind of is the opposite of that. So it's really creating that negative correlation to IME and look at more mean reversion strategies. So it's one thing that I've not really dabbled in too
Hmm.
much, just because I've just been purely focused on breakouts. Because if
And
you
it's
read,
been working, right?
yeah, if you read lots of books, the trend is your friend. You know, you look at some of
Hmm.
the most successful traders, a lot of them are trend following. So, you know, join them if you know if
Hmm.
they're saying it works, then it works. So that would be the next step. Long term goal is obviously, you see that Darwinex has like a pro system where I think you can basically incorporate sort of your own mini hedge fund as such. That would be the the bigger goal down the line, because at the end of the day, this is something that I enjoy doing. It's something that I see myself doing in 5, 10, 15, 20 years time. And, you know, the longer that I can do it for, the better. And that is definitely the next step of progression.
So it's kind of just like a natural scaling plan from here on out, right? For you, it's
Essentially, yeah.
you've laid the foundations, you've laid the groundwork. Now it's just a case of scaling and building that AUM and the
Yeah.
investor base, which I thought was going to be the answer. It generally is. I just think the great thing about you is you have that much fluidity in what you do. Like, you've already done something that often people don't think about doing until it's too late, which is building a portfolio. And every conversation that we've had, you've always been so focused on the risk. You've almost never actually mentioned your return when we've been
Yeah.
in conversation. It's always the other way around. And one thing I always say to our traders is, generally, and when I say our traders, I mean more of the guys who are coming up and trying to find their way, trying figuring out a strategy. And I say, the strategy that you build, it's the strategy's job to generate the return. You as
Yeah.
the trader or algorithm manager, whatever you'd like to call yourself, it's your job to minimize the downside and to maximize to mitigate as much risk as possible. Don't worry about the return. Don't force a return. You've developed your strategy to a point where it should have a positive expectancy. The only thing that you can manage is kind of the risk and the downside. And the fact that you're already doing that from running a portfolio, instead of going, I built one successful system, I'm just going to try and shove it out there, already speaks volumes about you as a trader, in my opinion.
Yeah. I mean, there's no point, looking at your return. At the end of the day, if you've got a strategy, that's the edge, as you've mentioned. Your job is just to be the risk manager. You want to be in the game as long as possible. An example would be is look at the recent volatility with what Trump's doing with the tariffs. The S&P shot down. People are panicking. They don't have a game plan. They've not been risk managers as such. So that's, at the end of the day, you've got to have a plan for risk.
Mm-hmm. Yeah, 100%. I couldn't agree more. And so the final question, Blayn, and it's a great one because I'm definitely listening to the response as well, is what would your advice be to somebody who is thinking of, completely doing a 180 from discretionary trading and venturing into algorithmic trading? What would your biggest piece of advice be, and where do you think these people should start?
The piece of advice I would give if you're starting out, like moving from discretionary to automation, is keep it simple. Making simple systems and building on them. That's probably the best thing you can do starting out with algorithmic trading. With your discretionary strategies, there's going to be so many rules, or lots of discretion. It's going to be impossible to code that into a system. So just try and keep it as simple and as mechanical as possible. Don't try build the most craziest system ever. You just, at the end of the day, build a system that has an edge, be a risk manager, and the returns will come.
Awesome. And where should somebody start? You haven't got to mention a course or a name, but just like, what should somebody do if they wanted to start?
Just do your research. There's plenty of books out there. There's plenty of people that will show you how to get started from the ground running. There's so much resources out there to get you started.
Okay, perfect. I'm definitely going to try it. I think you for me, you remind me of me because you used to trade discretionary, whereas a lot of guys that I've spoken to in the past, they've only ever traded from an automated perspective. So it's kind of difficult for them to give advice on how you make the switch, because a lot of them generally haven't experienced the emotions that a discretionary trader has. And I also think one of the other issues that you have when you come from trading already is often you're watching your algorithm perform, but your own mind gets in the way, and you're like, I wouldn't be in that trade. I'm not happy with that because I wouldn't have done that. And you can kind of become your own worst enemy.
Yeah, that's definitely something that could easily be done just by, again, your own thoughts on how you perceive price action or how you perceive anything in the market. But just understand that, even when you're discretionary trading, if you're hitting a 40% win rate, that's pretty good, or 50% win rate. So you're going to be wrong more than you're right. So just have that in the back of your mind when you're algo trading.
Yeah.
Don't intervene.
Awesome. Well, Blayn, I just want to say a massive thank you for coming on. You've been a fantastic guest, and you've actually been my first guest on the Darwinex channel. So I just want to say thank you for that. It's been great to catch up with you. And guys, I hope that you've enjoyed this episode. Obviously, it's been very algorithmic heavy, but I know we have a lot of algorithm traders and automated traders in our network anyway. So I hope you've enjoyed the episode. We'll be back in the next one. I'm going to try and get these out more frequently as well, so that we're going to bring on a lot of our traders so you can pick up nuggets from each and every one. Blayn, thank you very much, and have a great rest of your day, dude.
Excellent. Thanks for having on. You too.